What are some misnomers, Darius, about macro investing that you wish people knew?
Ooh, that's a good question. I would say the number one thing that I think investors get right or get wrong that don't understand macro is sort of making their portfolio reflect a singular macro view. Like at all times, there's always a range of probable outcomes. And now sometimes the range is very narrow. The distribution has a significant amount of excess kurtosis. Other times you can have a very flat leptocotic distribution where, there's a lot of stuff that could happen on the tails that, that has a much higher probability that you need to allocate resources to protect yourself against. And so one, understanding that the shape of the distribution of probable outcomes changes over time and is a function of the likely changes in path for growth and inflation and the policy reaction function therein, but also just making sure that your portfolio is acknowledging of that dynamic. If you're bullish, you don't want to be 100% long, whatever you're bullish on, or if you're bearish, you don't want to be 100% bearish on whatever you're bearish on. The more thoughtful thing to do, and the reason why professional investors consistently outperform and consistently have better sort of risk-adjusted returns than regular, retail investors or kind of mom and pop investors is the fact that they understand that there's a distribution of outcomes. And so they're layering their bets, not just across different themes. Our themes would be, Goldilocks, inflation, inflation, deflation. Someone else's theme could be China tech consumer story versus, U.S. autos and housing. They're layering their bets across themes, but they're also layering their bets across durations. Hey, I got these things that I'm long and short that I think should, I can monetize over the next 2 to 3 months. Here, these are things that I expect to continue building positions in, that if these things go my way, I'm probably going to get an incrementally better price to buy into for kind of a 6 to 9 month setup, or 9 to 12 month setup. So it's understanding that, hey, look, you don't have to be in one singular bet. You don't have to be operating in just one singular duration in order to make money. In fact, you're probably going to do a better job if you don't do those things.
Is macro investing mostly about broad sector bets or ETFs, or do you ever look at individual stocks?
You can apply macro to individual stocks. I mean, particularly some of these large mega cap stocks that have become real indicative of the broader macroeconomic cycle. They're obviously secular growers, but there's a point you get to a point where you're so big that even though you might be a secular grower, you're still going to be very much tethered to the broader economic and financial market cycle. I think of Netflix very much as a function of that. I think of Google, these types of companies, Facebook, obviously, they're tethered to the advertising cycle. Netflix is tethered to, the income cycle and people's willingness to spend, 12, 13, 14, $15 on, one of their 10, streaming services. And so, there's, you get to a point where you're so big that you are the economy. And so I do believe that is an issue with some of these stocks. But broadly speaking, you can try to do those things. But I think one of the things that I think I would caution against as an investor is assuming that you can apply one framework for every single market situation, every single trading setup. That's just not the case. You're a swing trader. I know for a fact that you will back me up on that. It's not always the same setup. You not always use the same models and the same tools. What you're trying to do, obviously, is find a tool or a set of tools that is pretty consistent in helping you generate returns, and relying on that, and more importantly, evolving that tool as you sort of get information along the way, because obviously you gotta have false positives and things of that nature.